So I want you to picture this. You are sitting across this, highly polished mahogany table from an institutional investor.
Oh boy. The classic boardroom setup.
Right, exactly. The room is quiet. The air conditioning is maybe a little too cold, and they just slide this crisp piece of paper across the table to you.
And that would be the term sheet.
That's the term sheet.
Yeah.
And they are offering you millions of dollars to fund your absolute wildest dream.
Yeah, which is a crazy feeling.
It's the capital you need to scale, to hire people, to conquer your market. It is right there, practically in your hands. But here is the high-stakes question you really have to ask yourself in that exact moment, like as you uncap your pen.
Yeah.
If their standard terms, quote unquote, were actually a carefully designed, legally binding trap to strip you of your own company, would you even know it?
I mean, it is a terrifying scenario to put yourself in. And the harsh reality is that most founders in that specific adrenaline-fueled moment, they wouldn't have a clue.
None at all.
No, because they see the zeros on the dollar amount. They feel the immense psychological validation of someone believing in their vision, and they just sign on the dotted line.
Yeah, they just assume the lawyers will figure out the rest, right?
Exactly. They assume it's just standard boilerplate stuff.
And the data on this is absolutely staggering. I was looking at this, and according to venture accelerators, over 40% of first-time founders sign term sheets without fully understanding the underlying jargon.
40%.
Over 40%. And we aren't just talking about a minor misunderstanding of some obscure legal clause here or there.
No, we were really not.
We are talking about catastrophic governance deadlocks down the line. Like, you could be building a wildly successful, profitable company and still walk away with absolutely $0 because of a few words buried on, page 4 of a legal document.
Which brings us to the core mission of today's deep dive, really.
Yeah.
We are translating the dense, intimidating, and frankly, heavily gate-kept lexicon of the startup ecosystem.
Yeah, it really is gate-kept.
It is. So to do this, we are unpacking an exhaustive masterclass created by StartupLanes, which is a global startup accelerator, and it's led by Dr. Shishir Gupta.
Right.
And the entire premise of this material, and really the reason we are exploring it today, is to help you realize that startup jargon isn't just corporate slang to make tech bros sound smart at coffee shops.
Right. It's not just buzzwords.
No, it is the literal, legal, and financial architecture of a business.
I am so excited to crack the code of venture capital language today, because when you look at it, it really is a distinct foreign language.
It really is.
And I love this quote from Paul Graham that the source material highlights. He says, "If you don't understand the vocabulary of your industry, you are at the mercy of those who do."
And it's hard.
It does. If you walk into that boardroom and you can't speak their language natively, you are the prey. That's why today's deep dive is titled Understanding the Startup Jargons, the Ultimate Lexicon for Founders.
Yeah, and it comes down to a matter of absolute precision. Because in the startup world, precision in language equals precision in execution.
Right.
When an investor casually throws out a term during a pitch meeting, they aren't just making conversation or, testing your knowledge. They are actively establishing the rules of the game they intend to play.
Yeah.
And if you don't know the rules, you cannot play, let alone win.
So let's start at the absolute foundation then. If you are going to play the game, you need the board. And in venture capital, the board is the cap table.
The famous cap table.
Right, short for capitalization table. This is basically the ledger of who owns what.
Yeah, it's essentially just a massive spreadsheet.
Just a spreadsheet that details the equity ownership breakdown of the startup, right?
Exactly. It lists the common shares for founders and employees, the preferred stock for investors, the options pool, basically everything.
And right alongside the cap table is the actual instrument that changes it, which is the term sheet. This is that document sliding across the mahogany table we talked about.
Right. And by definition, a term sheet is a non-binding legal document outlining the material terms of a proposed investment.
But there is a massive, incredibly dangerous caveat there that catches a lot of first-time founders off guard, doesn't it?
Well, absolutely. Because it's not entirely non-binding, is it?
No. The money part is non-binding, meaning they can still walk away before the final wire transfer clears if they find something bad in due diligence.
Right.
But other clauses in that very same document absolutely are legally binding from the second you sign.
And that is the trap. Clauses like exclusivity and non-disclosure are ironclad.
Yeah, let's talk about the exclusivity clause.
Often called a no-shop clause. It means you are legally barred from taking that term sheet and shopping it around to 10 other venture capitalists to start a bidding war.
Right, so you can't just take it and say, hey, look what this guy offered me.
Exactly. You are locked in for a set period of time, usually 30 to 60 days.
So you sign the term sheet thinking, great, I've got an offer. Let's see if Sequoia or Andreessen Horowitz will beat it.
But if you do that, you are in breach of contract.
And you can be sued. You are completely taken off the market.
Yeah. And while you are locked in, the biggest headline number in that term sheet is just staring you in the face, which is the valuation.
Right, the big number.
But the jargon here requires you to know the mathematical difference between pre-money and post-money valuation.
Okay, so pre-money is the estimated value of your startup before the new investment arrives in your bank account, right?
Exactly. And post-money is simply the pre-money valuation plus the total cash injected by the investor.
Okay, so let's put some real numbers to this so we can really feel the impact on the cap table. Let's say you've been grinding away in your garage, and an investor says your pre-money valuation is $4 million.
Okay, $4 million pre-money.
And they want to invest $1 million, so your post-money valuation becomes $5 million. But what does that actually mean for the founder's ownership?
It means the investor now owns 20% of the company.
Because they put in $1 million out of the new $5 million total value.
Exactly. And the math is crucial here because founders often negotiate the investment amount and the percentage they want to give away without clarifying if the valuation discussed was pre-money or post-money.
Oh, I see where this is going.
Yeah. If the investor meant a $4 million post-money valuation with a $1 million investment, they are taking 25% of your company, not 20.
Oh, wow. So that one little word changes your ownership by 5 entire percentage points in an instant.
In a literal instant.
Which is terrifying when you realize how loose early-stage negotiations can be.
Very loose.
And that brings us to how early-stage startups actually take that money. Because if you are just 2 founders and a laptop, you don't usually price the company right out of the gate.
No, you really can't.
You don't know if the pre-money is $4 million or $400,000. So founders use early investment instruments like SAFE and convertible notes.
Right.
Let's start with the SAFE. It stands for Simple Agreement for Future Equity.
And it was created by Y Combinator.
Right. And the key thing is it is not debt. There is no interest and there is no maturity date.
Yeah, essentially, an investor is giving the company cash right now for the right to buy stock later when a real valuation is eventually set by a larger venture fund.
So we really need to look at why the SAFE was invented because it radically revolutionized Silicon Valley, didn't it?
It completely changed the game. Because back in the early 2000s, founders were spending tens of thousands of dollars on legal fees just negotiating the alternative, which was the convertible note.
Okay, so what's the difference there?
Well, a convertible note, unlike a SAFE, is a short-term debt instrument that eventually converts to equity.
Ah, so it's actual debt.
Yes, and because it is legally classified as debt, it accrues interest over time, and crucially, it has a strict maturity date.
And that maturity date was essentially a ticking time bomb for the founder, wasn't it?
A completely lethal one. Just imagine the dynamic. A startup would raise money on a convertible note with, say, a 2-year maturity date. Building a company is incredibly hard, so inevitably the founders would hit a snag. Maybe product development takes longer than expected, or a key hire quits and they miss a critical product milestone.
Right, which happens all the time.
All the time. And suddenly, that 2-year mark hits. Aggressive note holders could legally step in and demand their cash back immediately, plus the accrued interest.
But startups are designed to burn cash. They don't have the money sitting around to pay back a massive loan.
Exactly, which is where the leverage comes in. If the startup couldn't pay, those investors could force the company into involuntary bankruptcy or use the threat of bankruptcy to take massive, controlling equity stakes for pennies on the dollar.
Wow.
Yeah, Y Combinator saw this dynamic destroying perfectly good companies and ruining founders' lives. So they introduced the SAFE.
And the SAFE was just a standardized open source 5-page document.
Right. It stripped away the debt classification, removed the interest rate, and completely eliminated the maturity date.
That is huge.
It was. It allowed founders to close capital in days instead of spending weeks in contentious legal haggling with their own early backers.
Okay, I see why founders love the SAFE. But if I'm an angel investor giving you money early without a set price, I need some kind of protection.
Naturally, yeah.
Why would I take all the massive risk of investing in a two-person team on day one if a giant VC fund is going to come in 3 years later, set the price, and get the exact same deal as me?
You wouldn't. Which is why both safes and notes use two protective mechanisms, which are valuation caps and discount rates.
Okay, let's break those down.
Well, the discount rate is pretty straightforward. It is usually set around 20%.
Okay.
That means whenever the next priced round happens, say a Series A, these early investors get to convert their safe or note into shares at a 20% discount compared to whatever price the new Series A investors are getting.
Got it. So it's a modest reward for their early faith.
Right. But the valuation cap is the real powerhouse. The cap is the maximum effective price at which the early investors' money converts.
Okay, walk me through an example of that.
So if you give me money on a safe with a $5 million cap, and 3 years later, my company explodes in popularity and raises a Series A at a $50 million valuation.
Oh, okay.
You get to buy your shares as if the company was still only worth $5 million. You get a massive multiple on your ownership because you took the early risk.
Oh, that is a huge advantage.
It is. However, founders have to be incredibly, painstakingly careful with how they use capped safeties, specifically regarding a phenomenon called cap stacking.
Cap stacking. Okay, what is that?
Well, because safes are so frictionless and easy to issue, I mean, you literally just download the PDF and sign it, a founder might treat them like an open ATM.
Right. So let's walk through this from a founder's perspective. Say I'm building my company. In January, I need to hire an engineer. So I issue a safe with a $4 million cap to an angel investor for $100,000.
Okay.
Then in June, I need server space. So I issue another safe with a €6 million to a small syndicate for $200,000. In October, I want to run a marketing campaign. So I do one more safe with an $8 million cap for another $300,000. I'm feeling great. I've raised $600,000 without paying a lawyer. And I haven't sold any equity yet because they are just safest.
And that is exactly the illusion that destroys companies.
Really?
Yes. You haven't sold the equity yet, but you have mathematically guaranteed it will be sold. Founders stack these capped safes without tracking the cumulative math in a pro forma cap table. They just keep signing PDFs.
Oh, man.
Then a year later, the company finally does a priced Series A round. What happens next is a violent mathematical awakening.
Because they all convert at once.
Exactly. All of those safes from January, June, and October trigger simultaneously. They all convert into equity at the exact same time, each using their own specific valuation caps.
So the January investor takes a massive chunk because of their low cap. The June investors take their chunk, the October investors take theirs, and the new Series A investors take the 20% they just bought.
And when the dust settles, the founders look at the updated cap table and suddenly realize that the cumulative dilution has wiped out their own equity entirely.
Oh my gosh.
They went from owning 100% of the company to owning 12%, all in a single afternoon. They basically sold the entire company in tiny, invisible fractions over the course of a year without ever realizing it.
Which brings up the dreaded D word, dilution.
Dilution, yes.
I want to read this brilliant quote from Naval Ravikant that the sources highlight. He says, "Raising money is not success. It is simply the fuel you need to attempt to build something valuable. Understanding your cap table ensures you actually own the vehicle you're driving."
That is such a perfect way to phrase it.
It is. Dilution is just the mathematical reality that when you issue new shares to investors, your personal slice of the pie gets smaller. But the pie itself is hopefully getting much bigger.
Right.
But the real danger, the existential threat to the founders, lies in anti-dilution provisions.
Yeah, anti-dilution clauses are designed to protect investors if you ever have to raise money at a lower valuation than your previous round.
And in the jargon, raising money at a lower price is called a down round, right?
Yes, a down round. It means the company has lost value. And there are two main types of anti-dilution protection. The first is weighted average.
Okay, what does that do?
This is the standard, relatively founder-friendly approach. It adjusts the early investor's conversion price based on a mathematical formula that considers both the size and the price of the new down round. It shares the pain of the lost value between the founders and the investors.
Okay, that sounds somewhat reasonable.
It is. But then you have the alternative, the full ratchet.
Okay, I was reading the deep dive material on full ratchet clauses, and it completely blew my mind. Let me try an analogy on you to see if I have the mechanics of this right.
Go for it.
Is a full ratchet essentially a financial time machine for the investor?
A time machine. I like that.
Like, say an investor buys a house with me for $1 million. we are partners. A year later, the market crashes terribly, and the house is only worth $500,000.
Okay.
A full ratchet clause magically rewrites the history of our contract. So it's as if they originally bought two houses for that same $1 million, instantly doubling their ownership percentage to make up for the price drop, and severely shrinking my ownership in the process.
That is a brutally accurate analogy. The full ratchet is a time machine that only works for the investor.
Wow.
It completely ignores the reality of the current market and forces the founders and the employees to absorb 100% of the financial damage.
That is wild.
To understand the devastation this causes, you really just have to consider the 2008 financial crisis. The global market corrected violently, capital dried up overnight.
Right.
Startups, and hardware startups in particular, which have massive upfront costs, they were suddenly forced to raise emergency bridge rounds just to keep the lights on and pay their staff.
Because they couldn't get normal funding.
Right. Because the macroeconomy was collapsing, these emergency rounds were priced at massive discounts. They were severe down rounds.
So what exactly happened to the founders who had agreed to full ratchet clauses in their previous rounds?
It was complete devastation. The moment they signed the paperwork for the emergency down round, the full ratchet clauses from their previous investors triggered automatically.
Oh, man.
It mathematically multiplied the preferred investors' ownership overnight to protect their initial investment value at the new, lower price point.
And to issue all those new protective shares to the investors, the company had to dilute someone, right?
Exactly. The employee option pools were wiped out. Founders who had spent 4 or 5 years bleeding for their companies, taking no salary, sleeping under their desks, were reduced to single-digit ownership stakes in a matter of hours.
Just hours.
Yeah. The investors retained their value, while the people actually building the vehicle were pushed out of the driver's seat. It is the ultimate cautionary tale of why you must read the fine print.
Wow. Okay, so let's say you've navigated this unbelievable fundraising minefield. You avoided the full ratchet. You didn't accidentally cap stack yourself into oblivion. You've structured your cap table beautifully. And you actually have the millions of dollars sitting in the company bank account.
Okay, best case scenario.
Right. Now what? Now we move from the boardroom to the engine room. This is all about operations and unit economics.
Yes.
Because the moment that wire clears, a ticking clock starts on a completely different existential threat, which is how fast you are setting that new money on fire.
Which brings us directly to the survival metrics, burn rate and runway.
Let's start with the burn rate.
Burn rate is the net amount of negative cash flow you experience per month. The sources break this down into two distinct numbers. You have gross burn, which is every single dollar going out the door, salaries, rent, software subscriptions, marketing, everything.
Total cash out.
Right. And then you have net burn, which is your total spending minus any revenue you are actually bringing in from customers.
Okay, so that's burn rate. And runway is just the mathematical combination of your cash and your burn rate.
Exactly. It's your total cash reserves divided by your net monthly burn rate. It tells you exactly how many months you have until you hit the wall, run out of money, and the company dies.
The runway is basically the most important number in a startup founder's life.
It really is. It dictates your stress levels, your hiring decisions, and your leverage in negotiations.
I have a practical pushback question on this, though. If burn rate is literally just negative cash flow, meaning intentionally losing money every single month, why do venture capitalists tolerate it at all?
That's a good question.
Think about a normal business. If you open a restaurant or a landscaping company, the goal is to be profitable on day one, or at least month one, you know?
Right.
You sell a service for more than it costs to provide. Why isn't the goal for every tech startup to be profitable from day one, rather than playing this highly stressful game of oxygen burn, where you are constantly racing against bankruptcy?
That goes to the very heart of venture capital theory. The fundamental difference between a traditional small business and a venture-backed startup is the scale of ambition.
Scale of ambition, okay.
Yeah. A traditional business aims for immediate linear profitability. It wants to grow slowly and steadily. A startup is designed for exponential, monopolistic growth. They're trying to capture an entire global market before a well-funded competitor does.
Right, it's a land grab.
Exactly. And to achieve that kind of scale, you have to spend heavily upfront on engineering the product, building the infrastructure, and launching massive marketing campaigns long before the revenue could possibly catch up.
So they are intentionally digging a massive hole, hoping there is a gold mine at the bottom.
It's conceptually known as the J-curve. If you look at a graph of a startup's cash flow, it looks like a J. It takes a deep, scary dive into negative cash flow for the first few years to build the unassailable infrastructure, and then if everything works, the revenue scales vertically.
So VCs aren't just tolerating the burn rate, they are actively demanding it.
Oh yeah, if you raise $10 million and tell a VC you are putting it in a savings account to earn interest and slowly grow over 10 years, they will fire you.
They'd hate that.
They want you to deploy that capital aggressively to grow faster than organically possible.
But losing control of that aggressive burn is fatal. The source material mentions an incredible case study about the social media management platform Buffer back in 2015.
Oh yeah, the Buffer crisis.
Buffer was experiencing the classic hypergrowth. They were flush with venture capital, and they just scaled way too fast. They were hiring globally, expanding initiatives, and frankly, completely not watching their gross burn.
Right.
And then the venture markets tightened up, the easy money stopped flowing.
And their leadership team looked at the math and realized they had lost control. They calculated their net burn against their cash reserves and realized they only had 4 months of runway left.
4 months.
4 months until complete bankruptcy for a company that everyone thought was a massive success story.
But what I absolutely love about this case study is how they handled the crisis.
It's very unique.
The instinct for most founders is to hide it, right? Pretend everything is fine, project confidence, and frantically try to raise more money in the background.
Fake it till you make it.
Exactly. Instead, Buffer's leadership published their exact financials internally to the entire company. They were completely transparent about the impending disaster.
Yeah, they just laid it all out.
And because everyone knew exactly what was at stake, the team rallied. They cut non-essential expenses immediately. They temporarily reduced executive salaries across the board. They initiated layoffs where necessary, but with full transparency.
And the result of that transparency, they achieved profitability in just 60 days.
60 days.
They brought their net burn to zero, stopping the clock entirely, and extended their runway indefinitely. They didn't need to raise desperate capital because they fixed the engine.
It proves that burn rate is not just some abstract spreadsheet metric for the finance team to worry about. It is a direct reflection of a company's operational discipline and culture. And StartupLanes has a very strict mandate on this in their operational playbook. They say, never let your runway drop below 18 months without initiating a new funding round.
The psychology of the 18-month rule is vital. Fundraising takes time, often 6 to 9 months from the first pitch to the cash hitting the bank.
Wow, that long.
Yeah, so if you wait until you have 6 months of runway to start fundraising, investors will smell the desperation. They will ask to see your bank statements. When they realize you are weeks away from missing payroll, they know you have zero leverage.
And that is exactly when those vulture capitalists swoop in and demand those full ratchet clauses and predatory terms we discussed earlier.
Precisely. They know you have to say yes.
So how do you make sure you eventually stop burning cash and reach the vertical part of that J-curve? You need a profitability engine. And the jargon for that engine is a CAC and LTV.
Right, let's define CAC first. Customer acquisition cost.
Okay, so that's basically what it costs you to get one person to buy your product.
Yeah, it's a simple, brutal metric. Take all your marketing spend, all your salaries, all your advertising costs for a given period, divided by the number of new customers you actually got, and that is your TAC.
And LTV is lifetime value.
Right.
That is the total net profit you mathematically expect to make from that one customer over the entire duration of their relationship with your company before they eventually cancel or leave.
And the relationship between those two numbers is the pulse of your entire business model. The golden benchmark in venture capital is an LTV to CAC ratio of 3 to 1 or higher.
Meaning you want to make at least 3 times what you spend to acquire the user.
Exactly.
To truly understand why this ratio is the holy grail, let's look at the extremes. What happens if your ratio is 1 to 1?
If your ratio is 1 to 1, it means you are spending $100 on Facebook ads to acquire a customer, and that customer eventually gives you exactly $100 in profit before they leave.
So you're just breaking even.
On paper, you might think you are breaking even, but you are actually dying.
Wait, why?
You are essentially working for free. And once you pay for your office rent, your legal fees, and your administrative overhead, things that aren't included in direct acquisition costs, you are bleeding cash rapidly.
Oh, right, because CAC is just the marketing part.
Exactly.
But the other extreme is where it gets really counterintuitive. What if your ratio is 8 to 1? You spend $100 to acquire a customer, and they give you $800 in profit.
Sounds great.
As a founder, you might be popping champagne thinking you have built the most profitable, efficient machine in history, but the source material says this is actually a massive red flag for venture capitalists. Why?
It's completely counterintuitive, but yes, at an 8-to-1 ratio, the boardroom won't be cheering for you. They will be demanding to know why you are starving the company of growth.
Starving it.
Yeah. If your product is that incredibly profitable per user, it means you are severely underinvesting in marketing. You should be spending way, way more to acquire customers.
Because you want to capture the market faster.
Exactly. Because while you are enjoying your high margins, you are leaving massive market share on the table. A well-funded competitor is going to come in, spend $300 to acquire that same customer, accept a lower margin, and completely dominate the market while you remain a niche player.
Wow.
You want to dial the spending up, driving your CAC higher until you settle back down around that 3-to-1 or 4-to-1 mark.
To see what a truly broken LTV to CAC ratio looks like, we have to talk about the Dropbox case study from 2008.
Dropbox is a perfect example.
Dropbox is ubiquitous now, but back then, they were struggling to figure out their acquisition engine. They were spending heavily on Google AdWords. Their CAC, what it cost them in search ads to acquire one single paying user, was hovering between $300 and $390.
And consider their pricing model. Their core premium product was only $99 a year.
So they are spending nearly $400 to get someone to pay them $99. That is a wildly negative LTV to CAC ratio.
Right.
Every single time someone clicked their ad and signed up, Dropbox was rushing closer to bankruptcy. They were subsidizing the internet.
And they realized very quickly that they couldn't buy growth through traditional channels. The math simply did not work.
So what did they do?
Their early growth lead, a guy named Sean Ellis, orchestrated a massive pivot in their acquisition strategy. He killed the paid AdWords campaigns entirely. Instead, he looked at human psychology and built a double-sided viral referral program built directly into the product.
Oh, right. I remember this.
The pitch was simple: invite a friend to Dropbox, and if they sign up, you both get 500 megabytes of free space forever.
It was brilliant because server space was incredibly cheap for Dropbox to provide, but highly valuable to the user. Suddenly, their existing users became their unpaid marketing team. They were spamming their friends, their coworkers, their families with referral links.
And the economic impact was staggering. Because they weren't paying Google for ads anymore, their customer acquisition cost plummeted to near zero. And because those referred users stuck around and eventually upgraded to paid plans, their LTV to CAC ratio exploded well past 5-to-1. They fixed the engine not by raising more money, but by changing the mechanics of acquisition.
Which provides the perfect organic transition for us. Because a great viral referral program only works if people actually love your product.
Exactly. You can't trick someone into referring their friends to a terrible piece of software.
This brings us to the most mythical concept in Silicon Valley, product market fit and its dark shadow, retention.
Mark Andreessen famously defines product market fit, or PMF, as the pivotal milestone where the market is pulling the product out of the startup as fast as it can be produced.
The sources describe it almost like a physical sensation for a company. Before PMF, you are pushing a massive boulder uphill. You are begging people to care. You are agonizing over every single marketing email. You are pushing features hoping something sticks.
It's exhausting.
But after PMF, you crest the hill, and suddenly you are chasing the boulder down the other side. You aren't pushing anymore. You are just desperately trying to keep the servers from crashing because consumer demand is so intense.
But for a very long time, PMF was treated as this subjective vibe by venture capitalists. Founders would get into pitch meetings, and investors would ask, do you have product market fit?
And the founder would just confidently smile and say, yeah, we feel it. The users love it.
Right. It was totally unquantifiable.
Until Rahul Vohra, the founder of the email client Superhuman, figured out how to quantify it.
Yes.
He didn't want to rely on a feeling. He wanted a metric. The source text details how he systematically surveyed his early users. He didn't ask them if they liked the product, because people will lie to be nice.
Sure they will.
He asked them one highly specific, emotionally driven question. How would you feel if you could no longer use Superhuman?
And the options were very disappointed, somewhat disappointed, and not disappointed. And through exhaustive statistical analysis of various successful startups, Vohra found the magic benchmark.
What was it?
If 40% or more of your users answer, very disappointed at the thought of losing your product, you have achieved true product market fit. You have become essential to their workflow or their life.
That is a revelation because it turned a subjective feeling into a hard, measurable data point that you could optimize for.
Exactly. If you survey your users and you are only at 20%, you have to face the hard truth. You do not have PMF.
And if you don't have it, you have to keep iterating. But what happens if you iterate and survey and you still can't break past that 20% mark?
Well, the market is definitively telling you they don't care about what you were building.
That is when a founder has to execute the pivot. A pivot is defined as a structured, fundamental course correction when your initial business assumptions fail.
Right.
But I have to push back on this term entirely. Is pivot just a polite Silicon Valley PR term for we failed completely, we wasted the investors' money, and now we are just starting over to save face?
I mean, it sounds like it sometimes.
Yeah. Like, look at the Slack case study highlighted in the text. Stuart Butterfield, the founder, spent years and millions of venture dollars building a highly anticipated multiplayer online game called Glitch. It launched, nobody played it, it failed.
Miserably.
So he shut it down and started an enterprise messaging app. How is that a pivot and not just shutting down a failed gaming company and launching a brand new software company?
That is a very fair critique, and it's a distinction many people outside the industry struggle with. The difference lies in the structural continuity of the organizational learning and the resources.
Okay, explain that.
A true pivot isn't a random jump into a new industry because you are bored. It is about leveraging an asset, a piece of technology, or a profound behavioral insight that was accidentally discovered during the initial failure.
So what was the insight for Slack?
Well, if we look closely at TinySpec, the company that built the failed game Glitch, Butterfield realized something profound. While the game itself was a commercial disaster, his engineering team, who were distributed across San Francisco and Vancouver, had built an incredibly efficient, custom internal IRC messaging system just to coordinate their own daily work.
Oh, because they were working remotely.
Right. They hated existing email and chat tools, so they built their own. Butterfield looked at the data and realized the game had failed, but that internal tool had massive, undeniable product market fit among his own staff.
Okay.
So he didn't fire everyone, liquidate the company, and start from scratch. He went to his board, returned the unused capital to any investor who wanted out, kept the core engineering team intact, and pivoted 100% of their remaining resources to refining and commercializing that exact internal messaging tool.
And that tool became Slack.
Which Salesforce eventually bought for almost $28 billion. Precisely. Or rather, consider the alternative. Had he just shut down and started over, he would have lost the team cohesion and the proprietary code they had already written. The pivot was about harvesting the diamond they accidentally created while they were digging for coal.
Okay, that makes a lot of sense. You are retaining the organizational muscle memory.
Exactly.
So let's say you execute the pivot, you find that diamond, and you hit Rahul Vora's 40% PMF benchmark. People love the product. Now, you have to make sure you don't lose those people.
Right.
That brings us to the concept of churn rate. Churn is the percentage of customers who cancel their subscription or stop using your product over a given period of time. But there are different layers of severity to this metric. You have monthly customer churn, net revenue churn, and then the absolute holy grail of software economics, negative revenue churn.
We need to break down negative revenue churn deeply because grammatically it sounds like an oxymoron. How can a metric measuring loss be negative?
Yeah, that confused me at first too.
It happens when the new revenue you gain from upselling, cross-selling, and expanding your existing customer accounts is mathematically greater than the revenue you lose from the customers who cancel.
Let's do the math on this so it's crystal clear for the listener. Imagine you run a software company. You have 100 customers, each paying you $100 a month. That's $10,000 in monthly revenue. In January, 10 of those customers get mad and cancel. You just lost $1,000 to churn. You are down to $9,000.
In a normal business, you are shrinking. But let's say you have negative revenue churn. You lost those 10 customers, but you still have 90 remaining customers.
Okay.
And those 90 customers love your product so much, maybe their teams are growing so they need more seats, or they upgrade to the premium tier for advanced features. Those 90 existing customers upgrade their plans, adding $1,500 in new recurring revenue.
So you lost $1,000 from the cancellations, but you gained $1,500 from the upgrades. Your net movement is positive $500. Total revenue for February is $10,500, even though you mathematically lost 10% of your customer base.
Exactly. Your company is literally growing from within. You could stop all marketing, acquire 0 new customers, and your revenue would still compound and grow every single month. It is the most powerful economic engine in the software-as-a-service world.
And conversely, fighting standard customer churn is a matter of absolute life and death. You cannot grow if your bucket has a massive hole in the bottom.
No, you really can't.
The Netflix case study in the sources illustrates this perfectly. Think back to the early 2000s, when Netflix was still a physical logistics company mailing DVDs in those red envelopes.
I remember those.
They had a massive problem, an 8% monthly churn rate. That is catastrophic. If you lose 8% of your users every month, you lose your entire customer base in a year.
And the root cause was friction. Users would sign up, watch a few movies, and then life would get in the way. They would forget to mail the physical envelopes back. Because they hadn't returned the disc, they couldn't get the new movies they wanted to watch.
Right.
They would look at their credit card statement, realize they were paying for a service they weren't utilizing, get annoyed, and just cancel.
So Netflix had to fight back on 2 distinct fronts. First, they tackled the psychological friction. They dropped late fees entirely. Blockbuster made all their money on late fees, relying on negative reinforcement.
Yeah, they did.
Netflix removed the anxiety, transforming a punitive transactional rental model into a passive, habit-forming subscription.
Second, they tackled the technical friction. They launched the Cinematch algorithm. This ensured that a user's movie queue was always effortlessly full of highly personalized, accurate recommendations.
So the user didn't have to think about what to watch next.
Exactly. The moment they dropped a DVD in the mailbox, the algorithm ensured the next red envelope was already on its way. By removing the friction of choice and the penalty of delay, they dropped their monthly churn rate below 4%.
Wow, cut it in half.
Yeah, and if they hadn't solved that fundamental churn problem, they never would have had the financial stability and the subscriber base to eventually fund their multi-billion-dollar pivot into digital streaming.
And speaking of financial stability, that brings us to the metrics that define modern startup success, MRR and ARR, monthly recurring revenue and annual recurring revenue. If you watch a single episode of Shark Tank or read TechCrunch, these are the acronyms everyone is obsessed with. This is the absolute lifeblood of software valuations today.
And we owe that obsession almost entirely to Mark Benioff and his company, Salesforce.
Why is that?
Before Salesforce came along in the late 90s, enterprise software was sold as perpetual one-time licenses. Think about the old Microsoft Office CD-ROMs you would buy at Best Buy.
Oh yeah, you just paid once.
Right. A massive corporation would pay a software vendor $5 million up front for a comprehensive software package, install it on their own physical servers, and then maybe pay a tiny fraction of that for annual maintenance.
Which meant revenue for software companies was incredibly spiky and unpredictable. You would close a massive deal in Q1 and have a record-breaking quarter, and then close nothing in Q2 and look like you were going out of business. You couldn't forecast your growth.
Benioff pioneered a philosophy he aggressively marketed as the end of software. He moved the software off the client servers and hosted it in the cloud, what we now call SaaS. And instead of charging a $5 million upfront fee, he charged a highly predictable $50 per user per month subscription.
It totally changed the game for how companies are valued, because ARR multiples completely dominate software valuations today.
They absolutely do.
If a venture capitalist looks at a company and knows with mathematical certainty exactly how much revenue is guaranteed to come in next year because of subscriptions, that predictability eliminates massive amounts of risk. That predictability allows the startup to safely compound their growth, borrow against future earnings, and justifies much, much higher enterprise valuations from Wall Street.
It's all about predictability.
Okay, so let's put it all together. You are a founder. You've navigated the term sheet. You've managed your burn rate and perfected your LTV to CAC ratio. You found product market fit. Your ARR is climbing to the moon and your churn is negative. By all accounts, your startup is incredibly valuable. It's time to sell the company and buy an island, right?
Not so fast.
But wait. Who actually gets the money when the company sells? This is where the jargon gets terrifying. We're entering the legal minefield of corporate governance.
This is where Dr. Shishir Gupta's core warning throughout the entire StartupLanes masterclass truly matters.
Yeah, this part is crucial.
He emphasizes repeatedly that a massive headline valuation means absolutely nothing if your liquidation preference stack wipes out your common stock payout.
Okay, break that down for us. What is a liquidation preference?
Liquidation preferences are the legal clauses that determine exactly who gets paid first and exactly how much they get paid during a liquidity event, like an exit, an acquisition, or bankruptcy. This is the actual mechanism of wealth distribution.
Let's look closely at the two main types of liquidation preferences. You have non-participating and participating. If I'm a founder, I desperately want non-participating.
Yes, you do.
Here's how it works. When the company sells, the investor has a choice. They can either get their initial investment money back right off the top, or they can convert their special preferred shares into common stock and just take their standard percentage of the whole pie right alongside the founders.
Right.
They calculate both numbers, pick whichever one is higher, and they take it. They don't get both.
It's fair. It protects their downside if the company sells for a low amount, but allows them to share in the upside if it's a massive success. But participating preferred, that is what the industry colloquially calls the double dip. And it is brutal for founders.
Walk us through the mechanics of the double dip.
A participating preference means the investor doesn't have to choose. When the company sells, the investor gets their initial investment back first, right off the top of the acquisition price.
Right.
And then, after they have made their money back, they still get to convert their shares and take their pro rata percentage share of whatever money is left over in the pool.
So they dip their hands into the pot twice, while the founders only get to dip theirs in once at the very end.
Exactly.
And it gets so much worse because of multiples. Right. In the jargon, you'll see 1x, 2x, or even 3x participating preferred. I want to dive deep into the Instamin liquidation trap case study from the sources because it is legitimately heartbreaking.
It really is.
Let's imagine you are the founder, you've built a mid-stage startup, it's doing well, and you get an acquisition offer from a larger tech company for $40 million.
$40 million, a great outcome.
Right. As the founder, you own 30% of the company. So you were doing the mental math. 30% of $40 million is $12 million. You are popping champagne, you are calling your family, you think you are set for life.
But you didn't understand the jargon you signed during your Series B funding round when you were desperate for cash. You had accepted a 2x participating preferred liquidation preference from an aggressive venture fund.
Oh, no.
Let's walk through the exact math of how that destroys your payout. Let's say those specific investors put in $15 million during the Series B.
Okay, $15 million.
First, we apply the 2x multiple.
Yeah.
Because it is a 2x preference, those investors have the legal right to take twice their initial investment back before anyone else sees a single dime. 2 times $15 million is $30 million.
So out of the $40 million acquisition price, $30 million is instantly transferred to those investors,
leaving only $10 million of the acquisition money left on the table.
But the founders don't just split that $10 million, do they?
No, because it is a participating preference, the double dip. Those same Series B investors now act like regular common shareholders for that remaining $10 million.
Wow.
Let's say they own 50% of the overall company equity. So they take 50% of the remaining $10 million, which is another $5 million.
Okay, so the remaining pool is down to $5 million.
But remember, there were other investors before the Series B. The seed investors, the Series A investors, they all have their own standard 1x liquidation preferences. They need to get their initial money back too.
Right.
Let's say they had invested $6 million collectively. They reach into the remaining $5 million pool, take all of it, and they're still short $1 million.
Which leaves exactly $0 for the common stock pool. The founders, the early engineers who took pay cuts, the people who spent years building the actual product that sold for $40 million, they walked away with nothing. Zero.
It is staggering, but it happens constantly. You can build a $40 million company, successfully sell it, and make absolutely nothing because of one complex sentence buried in a term sheet you didn't fully understand.
Let's move to the next set of boardroom weapons, drag-along rights and tag-along rights. Let me try another analogy here to visualize this.
Sure.
Imagine the startup is a massive bus. Drag-along rights mean that if the driver and the majority of the passengers vote to sell the bus to a new owner, you can't have one stubborn guy sitting in the back refusing to get off. The majority can literally drag him along into the sale.
Perfect analogy.
And conversely, tag-along rights mean the driver can't secretly sell the bus to a new owner, jump out, and leave the minority passenger stranded on the side of the highway with the stranger driving. They have the right to tag along on the exact same terms. Does that capture it?
That is a highly accurate way to visualize it. Let's expand on the drag-along scenario, because it protects the majority from individual sabotage. If the board and the majority of shareholders agree that a $50 million acquisition offer is the best path forward, drag-along rights legally force all of the minority shareholders to sign the sale documents.
And without this clause, you get catastrophic deadlocks.
Yeah. The source material highlights a famous 2012 case study. An estranged co-founder who had left the company on bad terms years prior still held 15% of the equity. He had no board seat, he wasn't involved in daily operations, but he held shares.
Okay.
A buyer offered $50 million to acquire the company. Because the early founders had used cheap, boilerplate legal templates, they lack a drag-along clause. The estranged co-founder reviewed the offer, realized how much money his former partners were going to make, and simply refused to sign the final paperwork out of pure spite.
Wait, can a 15% shareholder really block a sale if 85% want it?
If the acquirer demands to buy 100% of the assets free and clear, which they almost always do, yes, that single estranged co-founder single-handedly killed a $50 million acquisition, destroying life-changing wealth for everyone involved, simply because the legal architecture allowed him to.
That is just brutal. And tag-along rights, also known as co-sale rights, protect the minority. If the massive venture funds who hold the majority decide to quietly sell their shares to a private equity firm, tag-along rights allow the minority founders and angel investors to join that transaction and sell their shares at the exact same price.
Right, you can't be left behind in a company that just got handed over to a hostile new owner who might run it into the ground. It ensures liquidity is shared fairly.
Makes sense.
And speaking of protecting the company from the unpredictable actions of individuals, we have to talk about vesting schedules and cliffs. If you are a founder listening to this, and you have ever handed out equity to a co-founder on a handshake, this next section is going to keep you up at night.
Oh yeah, handshakes are dangerous.
Vesting is how you protect the cap table from human capital risk. The absolute standard in Silicon Valley is a 4-year vesting schedule with a 1-year cliff.
Meaning even if you are the founder, you don't actually own your allotted stock on day one. You earn it gradually over 4 years. But the cliff means you get absolutely nothing if you leave or are fired before the first 12 months are up. On day 365, 25% of your stock suddenly vests all at once.
The case study here is known as the $10 million vesting mistake. 2 friends start a company in a dorm room. They split the equity 50-50. Because they are best friends, they don't bother with lawyers, they just do a handshake deal and issue the shares outright with no vesting cliff.
Big mistake.
Huge mistake.
Right.
8 months in, the work gets hard. One guy gets bored, decides the startup life isn't for him, and leaves to take a safe, high-paying corporate job. Because there was no cliff, he legally keeps his full 50% ownership.
And the other guy stays. He grinds for 4 agonizing years. He manages the burn rate. He achieves product market fit. He builds the company to an $80 million valuation. And then the company sells.
And the guy who left after 8 months of messing around in a dorm room, who contributed nothing to the actual growth, nets $40 million.
Wow.
He gets exactly the same payout as the founder who bled for the company. It is the most expensive handshake in the world. As Dr. Gupta advises in the material, never ever distribute unvested equity on a handshake. A strict vesting cliff ensures everyone is economically incentivized to row in the same direction, and if someone jumps ship early, their unearned shares return to the company pool.
The final piece of the governance puzzle is board composition and protective provisions. You'll notice startup boards usually keep odd numbers, like 3 or 5. It's usually a founder, a lead investor, and an independent industry expert. This is specifically mathematically designed to prevent voting deadlocks.
Right, you can't have a 2-2 tie on a major decision.
Exactly. But the board seats aren't the only source of power. The protective provisions are where the real structural leverage lies.
Protective provisions are essentially veto rights granted to specific classes of preferred stock, usually the investors. They legally prevent the founders, even if the founders hold the majority of the standard voting shares, from making massive structural changes without the investors' explicit consent.
Like what kind of changes?
The founders can't sell the company, issue new shares, or take on massive debt without the investors agreeing.
If we look at the Uber case study from the sources, this is where protective provisions and board dynamics show their absolute teeth. Travis Kalanick was a legendary, incredibly powerful, fiercely combative founder. He built Uber into a global juggernaut. Most people assumed he was untouchable.
Right, he was the face of the company.
But during Uber's massive cultural crisis in 2017, the major VC investors on the board decided he was a liability to the enterprise value.
They utilized their protective provisions, their voting control, and their sheer financial leverage to legally pressure Kalanick into resigning from the company he created.
Which is wild to think about.
It is the ultimate proof that once you take institutional money, issue preferred stock, and build a corporate board, The board has the fiduciary authority to overrule, sideline, or outright fire even the most entrenched, famous founder to protect the financial value of the enterprise.
Okay, assuming you survive the board politics, you haven't been fired, the company has scaled massively, and it's finally time to cash out. We enter phase 5, the finish line. We are looking at exits, mergers and acquisitions, and valuations.
The exciting part.
When the general public thinks of a startup exit, they almost always think of the IPO, the initial public offering, where you ring the bell and list your stock on the NASDAQ or the New York Stock Exchange. But the sources highlight the direct listing as a powerful, modern alternative. Why bypass the traditional IPO?
An IPO is the traditional route, but it is incredibly expensive and structurally flawed for founders. It requires hiring Wall Street underwriters, massive investment banks like Goldman Sachs.
And they don't work for cheap.
Not at all. These banks charge exorbitant fees, often 5 to 7% of the total capital raised. But worse, they intentionally underprice your stock when they sell it to their elite institutional clients before the public market opens.
Why do they do that?
They want the stock to pop on day one so their clients make instant millions. That pop represents money the startup left on the table. Furthermore, an IPO forces founders and early employees into strict 6-month lockup periods where they are legally barred from selling their shares, exposing them to market crashes.
Right, so you're rich on paper, but you can't sell.
Exactly. A direct listing bypasses the investment banks entirely. You don't raise new capital, you simply list your existing private shares directly on the public exchange and let anyone buy them.
Spotify is the perfect textbook example of this. In 2018, they were already flush with cash. They didn't need to raise more money. They just wanted to provide liquidity to their early investors and employees. So they did a direct listing.
This is a huge move.
By cutting out the Wall Street underwriters, they saved tens of millions of dollars in advisory fees. They didn't arbitrarily dilute their stock by issuing massive blocks of new shares they didn't need. And most importantly, they let true, transparent, open market supply and demand dictate their opening valuation, which landed at an incredible $27 billion.
It was a massive flex of power by Spotify. However, the reality is, IPOs and direct listings are for the top 0.1% of companies.
Yeah, most companies aren't Spotify.
Right. Most startups will never ring a bell on Wall Street. The vast, overwhelming majority of successful exits are M&A, mergers and acquisitions.
Right, getting bought by Google or Apple or a private equity firm. And under the M&A umbrella, there's a very specific, somewhat controversial subcategory called the acqui-hire.
Oh yeah, the acqui-hire.
This is when a tech giant buys a failing or stalling startup, primarily just to acquire its elite engineering team, shutting down the actual product in the process. I have a critical question about this, though.
Go ahead.
Let's look at the logic. If a tech giant like Google just wants to hire the 10 elite AI engineers at a struggling startup, why bother buying the whole corporate entity?
Well, there's a couple reasons.
Why assume all their legal liabilities, deal with their investors, and pay millions of dollars? Why not just wait 6 months for the startup to burn through its runway, go bankrupt, and then just hire those exact same engineers on the open market for a standard signing bonus?
It's a great question. And it comes down to a mix of talent dynamics and defensive corporate strategy. First, on the talent side, elite engineering teams are cohesive, synchronized units. They have spent years learning how to communicate and code together.
Oh, I see. It's about the team dynamic.
Yeah. If the startup goes bankrupt in a messy, traumatic way, those engineers will scatter to the wind. Some will go to Google, some to Apple, some will start new companies. An acqui-hire allows the tech giant to buy the team completely intact and drop them onto a new project on day one, fully functional. That cohesion is highly valuable.
That makes sense. What's the second reason?
Second, there is the defensive strategy of neutralizing a threat. Look at Facebook buying Instagram in 2012.
That is the most famous acquisition in tech history. Instagram had essentially zero revenue and only 13 employees. And Facebook paid $1 billion in cash and stock for it. Wall Street analysts openly mocked Mark Zuckerberg. They thought it was the dumbest purchase ever made.
But Wall Street was evaluating it as a traditional business, not understanding the venture logic. Zuckerberg wasn't buying revenue, he was buying a moat. Facebook recognized a strategic existential threat. The world was shifting from desktop to mobile. Facebook's mobile app was clunky. Instagram was entirely mobile first, and their visual feed was addictive. If Twitter or Google had bought Instagram, they could have siphoned off Facebook's next generation of users.
Facebook didn't acquire them just for the talent. They acquired them to neutralize a competitor before it could mature into a true rival.
Exactly. They paid $1 billion for insurance and then turned Instagram into an advertising engine that is now estimated to be worth hundreds of billions of dollars. It was arguably the smartest acquisition of the century.
So how do they actually come up with these numbers when there's revenue involved? How do you mathematically value a software company that isn't publicly traded?
That comes down to valuation multiples and EBITDA.
Let's define EBITDA first. It stands for earnings before interest, taxes, depreciation, and amortization. It sounds like accountant jargon, but it's essentially a measure of pure core operational profitability before the taxmen and the bankers get involved.
Right. And the valuation multiple is a standard financial formula. You take a core metric, like EBITDA for a mature company, or annual recurring revenue for a fast-growing SaaS startup, and you multiply it by an industry benchmark to arrive at the total enterprise value.
Okay.
But founders need to understand that these multiples are not laws of physics. They fluctuate wildly based on macroeconomic conditions. The sources highlight a massive phenomenon known as the SaaS valuation compression.
Okay, let's talk about that.
To understand this, we have to look back at the zero interest rate policy era, what everyone calls the ZIRP era, during 2020 and 2021.
The ZIRP era was an absolute mania. Because the Federal Reserve had slashed interest rates to zero, massive institutional investors couldn't make any money in safe bonds. So they dumped trillions of dollars into risky venture capital, desperately chasing returns. The market was flooded with cheap capital.
And because there was so much money chasing so few good startups, the valuation multiples exploded. In 2021, software startups with decent growth were routinely raising money at valuations of 50 to 100 times their forward ARR.
100 times.
Yeah, if you had $10 million in revenue, VCs were valuing your company at $1 billion. Founders were locking in generational wealth on paper.
But then reality hit. Inflation skyrocketed, and the Federal Reserve spiked interest rates aggressively in 2022 and 2023. The cheap money vanished overnight.
Exactly. And the multiples violently, brutally compressed back down to historical rational norms of roughly 8 to 15 times ARR. This created a massive crisis. Startups that had raised money at those peak 100x multiples in 2021 suddenly found themselves massively overvalued relative to the real market.
Oh, I see, because the multiples changed.
Right. If they were burning cash and hadn't fixed their unit economics, they had to go back to the market to raise more money. But because the multiples had crashed, they were forced into severe down rounds. A company that was valued at $1 billion was suddenly only worth $200 million.
And this triggered all those full ratchet anti-dilution clauses we discussed earlier, wiping out founders and forcing incredibly painful recapitalizations just to survive.
Exactly. Recapitalization basically means restructuring the Nessie cap table, often cramming down early investors to make room for new ones.
But let's look at a more positive scenario. What if the company's doing incredibly well, it's highly profitable, but the founders want to stay private longer to avoid the regulatory nightmare of an IPO? Meanwhile, the early employees who've been there for 10 years want to buy houses, have kids, or pay off student loans. They are rich on paper, but have zero cash.
That brings us to secondary transactions.
Yeah, this is interesting.
This is a brilliant financial mechanism that has gained massive popularity. SpaceX is the ultimate textbook case study here. Elon Musk has actively resisted taking SpaceX public for decades because he doesn't want Wall Street analysts constantly demanding quarterly profits while he is trying to fund multi-decade missions to Mars.
But SpaceX needs to recruit and retain the absolute most elite aerospace engineers in the world who are being heavily recruited by Apple, Google, and Amazon with massive liquid stock grants.
So how does SpaceX compete if their stock is illiquid? They run structured secondary tender offers. Essentially, a couple of times a year, SpaceX allows major private institutional investors, like huge private equity funds, to buy existing vested common stock directly from the long-term employees at an agreed-upon valuation.
It is incredibly elegant. The company itself doesn't have to issue any new shares, so there is no new dilution. They don't raise new capital for the corporate treasury. The money goes directly from the private equity fund into the personal bank accounts of the engineers.
It provides massive, life-changing liquidity to the team without forcing the company to deal with the SEC and the public markets. It aligns everyone's incentives perfectly.
That is such a smart way to retain your people. Okay, let's move into our final section. There's a whole other layer of vocabulary we need to touch on that defines the daily operational life of a startup. We're going to rapidly explore the broader terminology from the A to Z glossary in the source text.
Sounds good.
Looking at this list, it's almost like the old myth about Eskimos having 50 different words for snow because they live in it. Silicon Valley has 50 different words for losing money and failing, you know? Burn rate, oxygen burn, J-curve, Death Valley, down round, because they spend so much time intimately navigating the reality of failure.
It truly is a language forged in the fire of high failure rates. Let's synthesize some of these terms by grouping them together. First, let's look at the growth playbook. You have bootstrapping, which is the absolute opposite of venture capital.
Okay, what is bootstrapping?
Bootstrapping means funding the company entirely yourself, relying on your own personal savings and the actual revenue generated by early customers. No VCs allowed, which means you retain 100% ownership, but you grow much slower.
Contrast that with growth hacking. This is a methodology that relies on rapid, low-cost, heavily data-driven experimental marketing to acquire users. You aren't buying Super Bowl ads, you are optimizing referral loops and SEO.
And when growth hacking works perfectly, you hit what investors call hockey stick growth. If you look at the revenue chart, it is completely flat for a long time, the blade of the stick, while you figure things out, and then suddenly it goes completely vertical, the handle of the stick.
And a huge mathematical driver of that vertical growth is the K factor, right? Let's explain the mechanics of that.
The K factor is the mathematical term for the viral coefficient. It measures exactly how many new users each existing user successfully invites to the platform. The math is fascinating. If one user sends out 5 invites to their friends and the conversion rate of those invites is 25%, your K factor is 1.25.
Because that number is above 1.0, your growth is theoretically exponential. Every user replaces themselves and then some. The product grows itself without marketing spend.
But if your invite conversion rate drops and your K factor falls to 0.9, the viral loop eventually decays and flatlines. Tracking the K factor is an obsession for consumer apps.
Then we have the product lexicon, the debate between agile development versus waterfall methodology. Waterfall is the old-school, rigid, sequential way of building software. You design the whole thing, you spend 2 years building it, you test it, and you launch it.
The massive risk is that 2 years later, the market has changed and nobody wants it.
Exactly. Agile is the modern startup way. It is about short development sprints, pushing incomplete features to a small group of users, getting constant feedback, and iterating daily.
Which leads directly to the concept of building a minimum viable product, or MVP. An MVP is not a crappy product. It is the most stripped-down version of your core idea that still provides enough value to test your fundamental business hypothesis with real users. You build it fast to see if anyone cares.
But you have to protect that MVP from feature creep. I've seen this kill so many projects. Feature creep is the gradual, uncontrolled addition of extra nice-to-have features requested by loud minority users or anxious executives. It bloats the software, complicates the code, and delays the launch indefinitely.
It distracts you from the core mission. Which brings us to the more cynical terms, the dark side of venture. My personal favorite, purely for the imagery, is the zombie startup.
It is such a tragic state for a founder to be in. A zombie startup isn't dead, but it isn't really alive. It makes just enough revenue to cover its operational expenses and pay the founders a modest salary. It survives, but it fundamentally lacks the exponential growth required to ever achieve a massive exit or reward the venture investors who funded it.
It's the Walking Dead of the startup world, just aimlessly wandering month to month.
Yeah.
Often, investors will pressure a founder to just shut a zombie startup down so everyone can move on and deploy their time elsewhere.
Yeah, that makes sense.
Then you have vaporware. This is software or hardware that is announced to the press with massive, highly produced hype videos and grand promises, but never actually gets built, finalized, or released to the public. It was just vapor.
We mentioned down rounds and oxygen burn earlier, but we have to mention the vulture capitalist. This is the ultimate predator in the ecosystem. This is an investor who waits until a startup is completely desperate for cash, maybe they have 2 weeks of runway left, and swoops in to offer a lifeline. But they impose brutal, punitive terms like extreme liquidation multiples and full ratchet anti-dilution clauses, knowing the founder has absolutely no leverage to say no.
And those vulture capitalists often justify their predatory terms by pointing to voodoo math. Voodoo math is a derogatory term for speculative financial forecasting that a founder presents, which relies on completely unrealistic assumptions. If a founder projects they will capture 50% of the global market in year 2 with zero marketing budget, the investors will rightly dismiss it as voodoo math.
Finally, let's look at the new frontiers of the lexicon. Everyone in the world knows the term unicorn. a privately held startup valued at over $1 billion. It used to be incredibly rare, hence the name, but the ZRRP era created hundreds of them.
Yeah, unicorns are everywhere now.
But a newer, much more interesting term gaining traction is the zebra startup. This is a cultural movement of founders who actively reject the growth at all costs, cash-burning unicorn model. Zebras focus on balancing steady, sustainable profitability with measurable social good. They want to be real, sturdy animals, not mythical creatures reliant on venture capital life support.
It's a healthy counter-movement. We also see acronyms expanding. SaaS, Software as a Service, has evolved into XaaS, which stands for Anything as a Service, indicating how cloud computing is moving beyond just software to infrastructure, platforms, and AI tools. And of course, Web3, the broad term for a decentralized iteration of the internet built on blockchain technology, which introduces its own entirely separate, massive lexicon of jargon.
It is just a staggering amount of information. If we synthesize all of this, from the term sheets to the cap tables, from the burn rates to the liquidation preferences, what we are really looking at is a vital toolset. Mastering this vocabulary transforms an intimidated, novice entrepreneur who is just happy to be in the room into a formidable, dangerous founder.
Exactly, and consider the power dynamic. When you understand the nuanced difference between gross burn and net burn, you can control your operational destiny before you run out of cash. When you understand the devastating math of participating preferred liquidation preferences, you can actively negotiate to protect the generational wealth you are spending years of your life trying to build. You cannot manage what you do not measure, and you absolutely cannot protect your equity if you don't speak the native tongue of the people sitting across the table trying to buy it from you.
Going back to Dr. Shishir Gupta's core advice from the StartupLanes Masterclass, jargon is not slang. It represents the binding, legal, and financial architecture of your entire life's work. And as Naval Ravikant reminds us so powerfully, understanding your cap table is the only thing that ensures you actually own the vehicle you are driving so fast.
It is the ultimate differentiator.
Yeah.
It separates the people who just have a fun idea for an app from the people who have the technical and financial literacy to actually build and defend a lasting enterprise.
We've spent this entire deep dive looking at the absolute granular mathematical mechanics of building, funding, and selling a company. We've talked about time machine clauses, deadlock boards, and millions of dollars evaporating into thin air.
A lot of scary stuff.
But it leaves you with a really provocative thought to mull over as we wrap this up. If so much of a startup's ultimate success or failure, whether the founders end up with $40 million in an island or $0 in a broken dream, is dictated by a few complex, esoteric sentences buried deep in a term sheet on day one, is the modern tech founder actually a product visionary, or are they just an amateur lawyer forced to learn an entirely new language just to survive the boardroom?
That's a great question.
Think about that the next time you are sitting across that polished mahogany table, holding a pen, looking at a stack of papers. You have to ask yourself if the millions of dollars they are offering is a runway to build the future you envision, or a perfectly designed legal trap waiting to take everything you've built.
Read the fine print.
Take a hard, critical look at your own agreements. Understand the true mathematical cost of the capital you are chasing. And whatever you do, make sure you know exactly what game you are playing.